Ladies and gentlemen, good day and welcome to the Barbeque Nation Hospitality Limited Q4FY22 conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to introduce the management for today. We have with us Mr. Kayum Dhanani, Managing Director, Mr. Rahul Agrawal, CEO and Whole-Time Director, and Mr. Amit Betala, Chief Financial Officer. I now hand the conference over to Mr. Kayum Dhanani. Thank you and over to you, sir.
Thank you very much. A very good evening, ladies and gentlemen. I take the pleasure in welcoming you to Q4 FY22 conference call of Barbeque Nation. We are happy to announce yet another remarkable quarterly operating performance at Barbeque Nation. The quarter started with a strong Omicron wave leading to dining operation restrictions. However, recovery post the third wave was equally steep, leading to a strong revenue growth during the quarter. For the last 2.5 years, the business has effectively sailed through 3 COVID waves, led by strong resilience of the brand and the team. We have seen diminishing impact of these waves in our business. Despite the third wave, the company reported a Q4 year-on-year revenue growth of 11% and an SSG of 5.5% and EBITDA margins of 20.1%. Even though FY22 was impacted by 2 COVID waves, the company has crossed pre-COVID FY20 revenues with year-on-year revenue growth of 70% and SSSG of 64.7% and an EBITDA margin of 18.6%. The business has structurally become more robust, led by a young and professional management team, a strong balance sheet, diversified revenue streams, and profitable presence across multiple geographies and brands. The company has proven track record of diversified growth engines like UBQ, Toscano, and Barbeque International. We have continued our growth in store count and added 12 new restaurants during the quarter, taking the overall store count to 185 restaurants. We have also upgraded our restaurant designs with newer look and feel, thereby further enhancing guest experience. With this momentum, we are confident of growing our restaurant strength by 35 to 40 restaurants in FY23. Over the medium term, we plan to take over network to 300 restaurants by FY25. While COVID-related worry seems to be subsiding as of now, the current operating environment has been challenged by a multi-year high inflation. While the input cost inflation has been significantly higher, the impact on our gross margins was limited due to improved operational efficiency. We will continue to take required measures to maintain our gross margins and profitability. With this, I will now hand it over to Rahul to take you through the performance of the company during the quarter. Thank you.
Thank you, Kayum. Good evening, everyone. I hope you and your loved ones are safe and healthy. To face the impact of 2 COVID waves in FY22, despite which the recovery has been strong, in FY22 we recorded 70% growth in revenue and 73% growth in EBITDA. Our delivery business has grown by 157% over FY21 and dine-in business has grown by 54% over FY21. Notwithstanding the impact of third COVID wave during the initial period of the quarter, the recovery in the second half of the quarter was quick and steep. Our operating revenues for Q4 FY22 were 251 crores as compared to rupees 226 crore in Q4 FY21, thereby registering a growth of 11% over the previous year. We reported same-store sales growth of 5.5% in the quarter and approximately 65% for the full year FY22. During Q4 FY22, our dine-in business has grown by 4% on year-on-year basis. Dine-in business was impacted in first half of the quarter by the Omicron wave, but recovered well during the second half of the quarter, which led to a year-on-year growth of 32% in the month of March versus March 2021. The share of delivery revenues to total revenues increased from 18% to as against 13% in Q4 FY21. The delivery business has stabilized well, and we have not seen any noticeable cannibalization despite ramp up on the dine-in business. Our restaurant network expansion has ramped up during the quarter with 12 new stores opened in quarter four, taking the overall store count to 185 as on March 2022. We further added 3 new stores in April 2022 and have a robust under construction pipeline of 14 restaurants and an equally strong pipeline of work in progress stores. Our reported EBITDA was 50.4 crore in quarter four FY22 versus 56.1 crore in quarter four FY21. Without the impact of Ind AS 116, the quarter four FY22 EBITDA was 22.8 crores, which is 9.1% EBITDA margin, as against 31.3 crores, which is 13.8% EBITDA margin in quarter four FY21. The reduction in EBITDA margins during the quarter were predominantly due to the impact of COVID wave 3 and inflationary pressures on input costs. With strong recovery in the business in the month of March 2022, the EBITDA margins have also recovered to normalized levels. With this, we'll now open the floor for interactive Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, sir. First question on Capex. In your cash flow, the Capex is about 93 crores. If I adjust for the Capex on the cloud kitchens, which might be about 3 to 4 crores, and increase in the capital work in progress, which is another 15 crores, we should see a Capex of about 75 crores approximately adjusted for this. And on the basis of 21-22 restaurants that we have added on a net basis, that works out to close to about 3.5 crores per restaurant Capex. Our understanding was that this number would be in the region of 2.7 or 2.8. So can you just explain what is the reason for the higher Capex per store?
Yeah, so the numbers that you mentioned are correct. So 93 from the cash flow statement, 15 from capital work in progress. That makes around 75 crores as the Capex incurred during the year. On these 75 crores, we have around 3 crores for extension kitchens, which leaves 72 crores. We have another 8 to 10 crores on maintenance Capex, which is what we normally do, around 5 lakh rupees per restaurant. So that leaves around 62 crores. And we have added 21 new restaurants in the year, and we have 2 closures, right? So the net new additions are 23. So on these 23 stores on 2.7 crore per outlet, we have around 62 crores of Capex. So broadly 62, around 8 to 10 on maintenance Capex, and around 3 crores on EPA. So that makes around 75.
Okay.
So despite the inflation also on the Capex side, we have managed to maintain the average Capex of 2.7 crore per outlet.
And how would this trend in FY23 given the inflation in commodities, etc., the Capex per store?
So we will try and maintain the same number. I don't think we'll reach that. Yes, there has been inflation even on the Capex side, but we've also been very strategically passing on some of the Capex on the landlords and taking up the buildings wherein some scope of work is going on the landlord. So that helps us to manage this. And some more work done on value engineering side in terms of the project. We have some rationalization on the unit space. So at times we have very strategically taken smaller space or not delivering the entire space to just manage this number at 2.7. And I don't see, even with the current inflation, this number should not get hit.
Right. In terms of store openings, this year we've had a very back-ended store opening. So do you think the same kind of phenomenon will repeat next year, or it will be evenly paced out across the quarters?
No, it should be evenly based out. The reason for the current year back-ended is we closed our fundraise by around end of last year, right? And then immediately after the close of fundraise, we entered into a COVID second wave, right? And to that extent, a lot of the disruption in terms of how the BD team or the project team operated should not have happened, but yes, it happened. And a typical cycle of a restaurant or a site coming inside the system to launch is approximately 150 days. So even during the second quarter, we were very comfortable with the pipeline of new stores, and that's why you will see, as and when they started coming on board, we saw around 7 sites last year, in quarter 3, and 12 sites in quarter 4. This quarter onwards, I see a steady, opening of around 3 to 4 sites every month now.
Okay. Secondly, just wanted to touch upon the pledge issues. Recently, RBL sold off some of the shares which were pledged. So what was the reason that they had to sell the shares pledged? Was there any kind of default on the loan servicing or something like that? And if so, what was the reason behind that?
So, Kaim, would you like to take that?
This is the operator here.
Yeah, Kaim?
Yes.
Yeah. Would you like to take that?
Actually, Mr. Dhanani had dropped from the call during these questions. We just reconnected him back. So the participant may have to repeat that part of the question.
Okay. So what I was asking is that recently RBL Bank has sold off some of the shares which were pledged. So what was the reason that they had to sell this off? Was there any kind of default on the loan covenants or servicing? And if so, what was the reason behind the same?
So basically, RBL was part of a consortium, or rather is part of the consortium of bankers, where in my other company, other business operations, where they had this the Barbeque Nation share as security, and during this COVID, we have had some issues with the other business, and whereby while the restructuring process was going on, they have taken a call. They have decided to offload these shares in the market and recover their part of the loan, because their committee wanted to come out of this association. So this is what they have done. It was definitely not in our control, and this is what has happened.
Okay. So just a lot of investors have been asking what is the sort of end game for this as far as resolution of the promoter debt is concerned. Would it be possible for you to share any kind of insight on this?
So, as far as the debt is concerned, the post-COVID, there were issues with the other businesses, and just like Barbeque Nation, we have deleveraged ourselves in multiple ways, and the restructuring process is also almost through with other banks, and business has improved a lot post-COVID. I don't see any such events happening in future, and I can assure you that. And of course, there are these pledges were of course disclosed even before the IPO, and there is hardly any pledge of shares is pending with Barbeque Nation with any bank now.
Right, sir. That's all from me. Thanks and all the best.
Thank you.
Thank you, Prasanth.
Thank you. We have the next question from the line of Trilok from Diamond Asia. Please go ahead.
Yeah, hi, good evening. Thanks for the opportunity. So, we obviously, when I look at the numbers now, we are doing nearly 50 crore EBITDA, on a quarterly basis. So, based on the initial comment that you highlighted about, 300 stores in next 3 years, and is my understanding correct when you said, what's the FY23 addition number that you're targeting in stores, revenue total stores?
So we are planning to add around 35 to 40 restaurants. So we'll reach anywhere between 220 to 225 restaurants in total.
Okay. So, my obviously the first question was, is it fair to assume that what I was thinking from a revenue per restaurant perspective and the total addition that you will end up doing in next 2 years at least till FY24, you might see we at least have a probability of in a normalized year, let's say in FY23 at least, the possibility of an EBITDA sort of doubling in the 2.5 years from here on, because assuming FY23 24 there is no external disruption. Is that thought process correct, or do you think there is something else that you're missing, some major points?
So, based on our model, like we have always, also mentioned, we believe we should do around 7 crore, of revenue per outlet, with a store margin of approximately 21%, and a corporate level EBITDA margin of approximately 15%. The numbers that you will see in FY22 would have, in at least 2 occasions impacted by wave 2 and wave 3. To that extent, there is some disruption. But otherwise, in our month-to-month numbers that we see, like we also mentioned in the month of March, which was a pretty normalized month for us, the business has pretty much performed at the same level. So, our priorities today is continue to expand the network in a thoughtful manner. Try and maintain your rent percentages at the discipline that you have maintained over the last 15 years, and keep the guest excitement on, so that this percentage of 7 crore should maintain, right? And on a normalized basis, we expect a same-store sales growth of around 5 to 7% on the existing portfolio. Obviously, for FY23, given that FY22 numbers were slightly impacted by second and third wave, FY23 strictly on a SSG basis will be far higher. But on a normalized basis,
that's also a function of base only. Yeah, I agree with you.
Yeah.
So just to add further, when you said 21%, this is pre-Ind AS, correct? Margins.
Yeah. So all the numbers that I mentioned is pre-Ind AS.
And when just from a delivery perspective, we had started that as an experiment, and now we are seeing this kind of numbers. 45 crore you guys did this quarter as well. So where do you see that settling, or do you think this delivery probably will phase out once in normalization returns? Or any thoughts? Because this quarter also in some manner you had some benefit of wave 3 also impacting you. If you can give your thoughts or color on how should we think about delivery revenues going forward?
So first of all, no, delivery was not an experiment. Delivery was a very thoughtful exercise that we wanted to do. We actually started it in November 2018, right? So we ran it almost 1.5 years pre-COVID also. But the real attraction in this business came in post-COVID. It got accelerated, and also pre-COVID we didn't have Barbeque in a box. During COVID times we launched Barbeque in a box, which has got phenomenal response from our guests, and that's why you see almost 7x, 8x growth in delivery over FY20 base. It has always been a priority for us, right? And as the industry delivery volumes are going up, we are also benefiting from that. On a smaller base, obviously our growth rates are far higher. So our plans on delivery would be to keep growing it at almost 20% CAGR over next few years. And I don't think it is a substitute to dine-in. Like you see over last 4 quarters, despite the fact that the dine-in ramp-up has been extremely strong, our momentum on delivery side also has been continuing extremely well, right? So even if you look at as compared to previous quarter, which is a seasonally better quarter, our delivery revenues have been holding up pretty well. I don't see that there's any risk of cannibalization from this. If at all, we would plan to only grow it higher.
Understood. And if I may ask, there is a lot of inflation that we have seen across food items, and you would also be across other items apart from food as well. What sort of gross margins, or what kind of price hikes, do you plan to take, or do you have already taken any? Will help us to mitigate gross margins, and how do you plan to tackle inflation in the near term or in near to medium term?
Yeah, so it has definitely impacted us also. In quarter 4, we did not take any price hike. We actually, obviously entered quarter 4 with the Omicron wave, and then in the month of March, the priority was to get as much volume as you can. And I'm happy to see the volume numbers that we saw in the month of March. In the month of April and May, both the months put together, we have taken approximately 5% price hike, which should help us to reclaim the gross margins that we used to do earlier. Also during quarter 4, while the impact of inflation was far higher, there was a lot of work on the ground done on managing the consumption per tax of various high commodity items, menu engineering, tracking of wastages, trying and having as much precision on forecasting as possible. So those measures were taken, and that's why the impact that we see on gross margin is far lesser than actual inflation. Having said that, this quarter we have taken price hike, and we're already, seeing that the gross margin should revert back to where it used to be earlier.
So whatever price hike that you've already initiated will be sufficient to take the gross margin back to maybe previous level. Is there any?
Yes.
I mean, intuitively, obviously, it's very it's not a price sensitive, price elastic, inelastic segment. But have you seen any impact or what kind of has the price hikes been well accepted by the customers? What kind of, if you can give some quantitative sense, how the April has been, or has the trend been as good as March is, or it's like lower than that?
Oh, so yes, it has been. Well, look, April month had two seasonal impact. One is the month of Navratri and also Ramzan, right? So in both these months, there is some impact on non-veg consumption, Navratri, and then Ramzan, the lunch consumption goes slightly lower, right? So barring that impact, I think the volumes have not been impacted by the price hike. Also, like that, our value proposition is that we are a value for money brand, right? So we want to maintain that. But having said that, we are also a celebration-driven brand, right? Which means that if somebody is coming in a group of 4 or 5 and spending approximately 4,000 rupees for the meal of 4 or 5, that 4,000 rupees going up to 4,100 rupees also does not pinch that strongly, right, to the customer base that we address to. So I think the business has got flexibility to take price hike in the range of plus minus 5 to 10%. But it has to be done in a calibrated manner so that the value for money perception of the brand should not go off the track, right? So it is a tactical balance between the two that we keep taking. And like I said, the price hike that we have taken in quarter 1 is good enough. In case the inflation further goes out of whack, I think the business has headroom to take some more price hike to maintain the gross margins.
Understood. Thank you very much. I will come back in queue. Thanks for the question.
Thank you, Tilak.
Thank you. Participants are requested to please restrict your questions to 2 per participant. Participants are requested to please restrict your questions for 2 per participant. I now invite Mr. Harit Kapoor from Investec to address the management.
Yeah, hi, good evening. So just the first question was again on the gross margin side. You said that this 200 bips contraction is largely due to the cost side. You were not able to kind of offset it with the pricing. So Rahul, assuming that you've passed it on and things are normalized, you should kind of get back to your erstwhile level. My question was more on fiscal year 24. If you have a normalized commodity cost environment, some of these on-ground benefits that on-ground initiatives that you've taken, could some of those fructify into gross margin improvement? Maybe in the last few months, these initiatives are not fructified because of the high inflation. I just wanted to get your sense on gross margin slightly longer out, apart from these last 6 months, apart from the next 6 to 9 months.
So that will be, and barring inflation, if I just look at the same pricing level, the same consumption level that you used to have in say FY20 versus now, there is benefit on the gross margin level, right? So I think in longer term, if you look at 3 to 4 years, we would endeavor to take this gross margin percentage from anywhere between 65 to 66% that we currently have to a band of at least 67 to 68%, right? So those measures will keep impacting the business.
And on the just a follow up on this, so you said about the 5% price hike. Have you guys seen that across dine-in formats, you hear and seating, so across dine-in formats, price increases would have been kind of taken place, and so to that extent you're kind of competitively neutral?
I tend to believe that. So based on my recent checks in the industry, yes, this inflation bit is pretty much impacting everyone, and I would assume that they would have taken that. Our industry is highly unorganized, right? So what you see in one local trade area in say any metro markets can't be very clearly brushed up across the country, but as a brand having presence across 82 cities, data from close to 95 restaurants, the price hike impact on volumes, we have not seen that. Plus, one of the other important metrics to track in this case is cancellations, right? So the moment you have price hikes and the customer feels that the overall cost is going to be higher, you will see a spike in cancellations, which you have not seen between pre-price hike level and the post-price hike level.
Got it. And last thing was on the March performance. So you mentioned that margins are kind of EBITDA level margins are kind of back to erstwhile levels. And from a year-over-year basis also, you spoke about 30% odd growth. I think March last year would have partly been impacted due to last week maybe would have been impacted due to the second wave. So of this 30 odd percent, and then also you had incremental restaurant additions. And so what would be your estimate of kind of SSG for March?
Just for the month of March, must be around upwards of 20%. So overall, the top line for the month of March specifically was around 95 crores, and I think I don't often remember the SSG number for the month of March, but should be around 20% plus.
Got it. That's it for me. Thanks.
Thank you.
Thank you. We have the next question from the line of Avi Mehta from Macquarie. Please go ahead.
Rahul, hi team. Thanks a lot. My question was again on inflation. Hi. First was essentially which inputs have seen the most inflation, and what would be the rough quantum? If you could kind of give us a sense of where is it that we are seeing that?
Yeah, so largely meat. So our meat basket is approximately 40 to 45% of our total, food cost. And during the entire quarter and months, we've seen varying rates. Our prawns were slightly higher in the month of January. It's actually came down a bit in subsequent months, and then subsequent months, chicken prices went up in early double digits. Right, so it's pretty much a mix of both the commodities. Fish also is largely imported, so we have some impact due to the supply chain disruption that is actually continuing for a long period of time now, right? So it's all put together. One advantage that we have is that given that we don't have a fixed menu and we offer all you can eat, we do also have flexibility to juggle between these commodities and add extra dishes of of maybe more affordable items and lesser on the high cost items, right? So that menu engineering is again a very operating call which we take on the ground by tracking the food cost per cover very closely, and our MRPs are extremely strong. So that's why in Q4, despite the price hike that we have seen and input costs, despite not taking price hikes, we have actually managed very good gross margins.
Got it, Rahul. So essentially about half of the input basket, which is meat, is seen a double-digit inflation, which is what you're now going to pass to that 5% price increase. That's the correct one.
Yeah.
And last question essentially was to kind of just understand the historical context. Last time when you would have seen this food inflation, could you give us a sense on how was our brand performance? Because we don't have that data, but maybe you could kind of give us some understanding. How was that then, and how are things different versus then? Just to kind of have some context around where inflation is, how have we responded earlier, and what are the levers we have additionally. Thank you.
So, without talking about any specific period, but if I look at last 8-year history of Barbeque's performance, the CAGR on inflation is what you know. The food cost per cover CAGR would not have been more than 2 or 3%. In fact, on a per cover basis, it would be lower because of various efficiencies that have been coming to the system as the scale has moved on, right? So if I compare a period of 2014, 2015, the gross margins would be around 61-62%, which has moved up to around 66% now. So that has happened. And the price hike, barring the current price hike, if I look at the average per check CAGR over last 5 years, it would come to around average CAGR of around 2 to 3% only. Right. So I think overall margin improvement that has happened more from internal efficiencies and benefits of scale, and not requiring to take a price hike. I think in the current operating environment, a good thing is that in the past we have room to take these price hikes, and we have utilized that in the current quarter.
Okay, well, perfect, Rahul. That's all from my side. Thank you very much. And wish you luck.
Thank you, Abhi.
Thank you. We have the next question from the line of Ashish Kanodia. Please go ahead.
Hi, Rahul. So on March, you talked about closer to 95 crore kind of revenue run rate. So just wanted to understand, there is a restaurant.
Sorry to interrupt you, Ashish, but your voice is not very clear. Request you to go off the speakerphone.
Yeah, is it better now?
Yes, yeah, we can hear you clearly now.
So Rahul, on operating margins, right, when we look at your PPT, so even for the fully operational stores, the margin was around 15.5%, and I see the disclosure that there was some restrictions. Even for fully operational store, there were a few constraints, right? So is it possible to give some color on where these margins have been, say in March or April?
Yes, so recovered in March to normalized levels. Also in Q4, full ops has operating restrictions like sitting restrictions and timing restrictions. Unfortunately, operating leverage obviously takes negatively when your base top line is not achieved, right? And as a team, we have taken a conscious call of not cutting down on cost so significantly. And I'll tell you what I mean by that. In our industry and like any other industry, we are facing attrition a lot, right? We are in a phase of the company wherein we are looking to expand more restaurants. So at that point of time, managing your employee cost by reducing your manpower does not make any sense, right? So we have actually carried the entire manpower, and that is helping us now when we are expanding very well. And those sort of things have impacted the month of March. Rental waivers, which we used to get during previous COVID periods, have been very minimum in the third wave, largely because most of these landlords have supported us very well during the first 2 waves, and that percentage has actually come down in the third wave. So the dual impact of both these high fixed costs, which is manpower and rental, the margins during the third wave were actually low. As compared to the previous COVID periods, was far better, but as compared to a non-COVID normalized month, it was low, right? But in the month of March, now we have seen store level margins coming back to close to 20% that we used to have. And this I'm talking about the portfolio level. All right.
Sure. Rahul, that's very helpful. And secondly, when on the extension kitchen side, now you have around 15 extension kitchens. So what's the thought process on that? Maybe more from a 2-year, 3-year perspective. Do you see this 15 extension kitchens becoming, say, around 50, 55, or even higher than that in the next 2-3 years? And where do you see? And once you ramp up those extension kitchen, where do you see your delivery revenue? Kind of stacking up?
So on the extension kitchen side, their contribution to overall business is very low, right? We have tried those as an extension to reach to our guests to the more closer to where they are. And with 15 on board, we don't expect to add more than maybe 2 to 3 in the short term. I think we will wait for the revenues to also start tracking up in a manner that these extension kitchens reach to a 15% at least store level margins. Right now they are not. They are at early single digit EBITDA margins. They do give us a kitchen infrastructure which can be actually utilized to further leverage your delivery portfolio, and that's the thought process there. I would say it's still a work in progress strategy. It's very difficult to give a firm number on number of extension kitchens. It's a small capital outlay. We're very nimble in terms of deciding that. If we find that some of our nearby barbecue outlets are doing very good on delivery, they are actually also leading to some metrics not being at par with what it should be because of huge volumes, we go ahead and open extension kitchen. Right. So I would say wait for maybe 2 more quarters to see how this unfolds. We're also not in a hurry to prove that. We'll just take it very cautiously.
Sure, Rahul. That's very helpful, and thank you so much.
Thank you. Thanks, Ashish.
Thank you. We have the next question from the line of Pratik Podar from Nippon India Mutual Fund. Please go ahead.
Hey, hi. Just one question. I heard you talked about 30% YOY growth in the month of March. Just a bit puzzled when you said that margins would have normalized in the month of March with 30% growth on a YOY basis, and last year March was fairly normalized, if I'm not wrong. Your ROM should have gone up, right?
So if you look at 95 crores quarter 3, also we did approximately similar numbers, right? We did around 285 crores, which is the average of 95 crores. We did pretty much similar numbers in the month of March. And in the month of, in quarter 3 also our restaurant operating margins were around 21%. So it's pretty much at the same level.
Okay. And second question is, just if you could talk a bit about your delivery business. Since you've not taken any price hikes, I'm assuming that the sequential decline is all volume decline. Anything to read into this? Because, we had the wave, so I would have thought this should have gone up, or was it that this time the wave had a negative impact on delivery business? Because most of the guys had COVID, right? So.
No, so I think I didn't notice any significant increase in the delivery volumes because of the third wave, not for our business also. And in the third wave, what has actually happened is that the volume has gone up, overall transaction volumes. The average per check has come down. And this is, in our case, actually more because there is shift between shift from more items per order, or earlier the consumption per order was maybe done by groups of between 2 to 4. And now that has gone to single consumption orders, right? So even though the order volumes have gone up, because of the decline in the average per volume, overall sales volume has come down. Also, quarter 3 was a seasonally better quarter, right?
That point is healthy.
Yeah. So on a like-to-like basis, sales are well maintained.
And given that you have had some experience around delivery now, what's the repeat percentage like? How many customers are repeat on the delivery business?
We don't have all the data because large portion of our business comes to aggregators.
And on your app, I remember in your PPT you talked about 25% of the business, but I'm assuming that would be also on the dine-in side where people will be reserving online on the app.
Yeah.
But just on your app, anecdotally, if you were to see, is there a decent repeat customer base who's coming and having frequent usage of?
Yes, a large portion. Also, a large portion of our delivery orders on app have the Barbeque loyalty points applied, which is the smile points. And we are slowly and steadily seeing very good adoption of the Barbeque loyalty points also. So the repeat business on our app is very high, which is driven by a mix of both loyalty points and in general repeat customers on the platform.
And lastly, just wanted to check, at least when I was doing this anecdotally, I see a pricing difference between aggregators and your own app for UBQ or Barbecue in a Box, right? Those formats. Any specific reason or how should I think about that?
No, there should not be on the MRP side, but maybe because of some promotions being running on different platforms, some from our side, some from aggregator side, you might see a price difference. But otherwise, on the MRP level, both are same.
Got it. Really helpful and all the best for the coming future. Thanks.
Yeah, thank you, Pratik.
Thank you. We have the next question from the line of Manish Podar from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi Rahul. Just two questions. First one is, would you be able to help me understand the new stores which you're signing? What is the rent as a percentage of sales?
Look, the sales ramp up has to happen, right? So if you look at the new stores, they are not in last quarter one would not have run for more than three months, right? So as the sales normalize, based on our projections, these won't go beyond 10%. Say by year in the year two sales.
Okay, because when I look at other expenses, let's say divide by the store, just a crude way and not taking average. When I compare to the base quarter versus this quarter, there hasn't been any inflation as such. This would number up roughly about 4 million odd other expenses per store. So what are the savings which you're getting here, or is it largely to do with the Jan month being not there?
It's largely Jan month, but otherwise on the rental side, are the new leases better than the averages? No. But one difference on the new lease also is that it's more skewed toward metro markets. So technically may have higher rentals, but despite that, our rentals on the new lease would be at pretty much same level of around 10 to 10.5%.
Okay, and just one thing. So we haven't seen a normal quarter for quite some time, and we don't have the trading history. So is there any seasonality in the business as such? Let's say, should one look at numbers sequentially, or do you look at numbers YY generally?
Yeah, there is. So typically in the entire year, quarter three is pretty much the best because of the festive season, right? Followed by quarter four. Because of a good January that you normally see. The initial days of January also helps you a lot. Then quarter one, some school holidays that you see. Quarter two is really the worst because of rains, because of Shraddh, because of Shravan. Some of these impact non-veg consumptions, right? So that's the way it is. But broadly, your H1 should give you approximately 45 to 47% top line, and H2 gives us around 53 odd percentage top line.
Okay, fair enough. Thanks.
Thank you, Anish.
Thank you. We have the next question from the line of Varun Singh from IDBI Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, my question is on Toscano, La Terrace and Collage. Sir, how is the business over here? Because now it's been close to 2 odd years since we acquired Red Apple, and so now I just wanted to understand how the business is tracking, how the health of the business is, and how we are thinking about expansion in these 3 franchises in future.
Yeah, so just one clarification. Toscano, Collage and La Terrace, both La Terrace and Collage are actually sub-brands of Toscano only. So all three are part of the same Toscano brands. Those two are not different franchisees. We have taken a selective call to move to a multi-cuisine in one restaurant only by the name of Collage, rather than just doing Toscano. So as a strategy, long term, the only brand that you want to grow is Toscano, and not spend bandwidth on multiple brands, right? So that's Toscano. It has grown extremely well between last year and this year. The revenues have actually doubled. And despite in FY22 there was impact of obviously two waves which also impacted Toscano, and it's shaping up pretty well. The margins are very strong there. We have closed one restaurant this year in Toscano, and we have opened one more restaurant this year. So the net number didn't change to 11, but subsequently we have opened one in the month of April. One more is opening up in the month of May. And the plan is to take this store count from 11 to approximately 16 to 17 by end of this financial year. So almost 50% addition on the existing base. Run rate revenue wise, it is doing extremely well. And in fact, both Toscano and international business, both of these businesses has moved to a current monthly run rate of upwards of 6 crore rupees per month, each individually, right? So I think both of these are very strong, profitable franchisees, and in a good path to grow. Our long term on Toscano is that we want to take it to 100 outlets. And if I look at Barbeque Nation in 2013 also was around 18 outlets, and now we are close to 168 outlets in Barbeque Nation. That's the growth story which I believe Toscano should also take. The brands have all the attributes to read the same story.
Understood. And sir, my second question is on the delivery business. Sir, what are the metrics that we are tracking to understand the robustness of the I understand one of the participants has asked about the repeat customers data, in case if we are tracking to that category. But if not repeat customers, sir, how we are making measurement of how strongly we are able to drive growth, not just growth in numeric terms, but the quality of the delivery business. And so if you can share some view over there, sir, that will be very helpful.
So you don't get customer data, but there's a lot of operating data that flows on each side, right? We obviously track daily ADS on delivery by store. We track the KPT, which is kitchen prep time by store. There's something called NFR, which is marked food ready by our guests. Timing between marked food ready and actually ordered being picked up. So there are a lot of operating metrics. The overall delivery time to the guest. There are also data on how many customers were say dissatisfied with your food, right? So there's something called IGCC and for Swiggy and ORS for Zomato. So these data flow to almost all the brand, and we have organized this in our own internal MIS platform, and we track it across all our restaurants. So these are on the operating side. Also ratings, which has like I said earlier, has improved significantly. So those are all working extremely fine. A lot of data on menu, so which product is working, which is not working, what needs to be done, or what can you add to the basket, how many customers order the box and then also order additional say breads. So these data are all available, and there are a lot of data crunching that has been happening at the back end on all of these metrics, and that's why we see the delivery business reaching where it is today. So there's a focused team who look after delivery business in our company, and is growing that.
Understood, sir. That's very helpful. Thank you very much, and all the best.
Thank you, Varun.
Thank you. We have the next question from the line of Raikin Gopani from Capri Global. Please go ahead.
Hi, sir. Thank you for the opportunity. I had two questions. Firstly, on the expansion of stores, you now target about 35 stores to be opened. if you could share some color in terms of have you accelerated this expansion plan, and if so, what are the kind of geographies that you intend to expand this in terms of or tier 1 or tier 2? How do you intend to accelerate this?
So we would like to maintain the current mix. We have around 70% in metro and tier 1 and around 30% in tier 2, tier 3. If you look at this year, we have more skewed towards metro and tier 1 markets. I think the rentals in some of these markets are also sensible. And we actually don't just look at this geography we have to go. We are very conscious about what kind of sites we sign. So at any point of time, we would have a pipeline of almost 2x of the number of stores that we want to do. And one thing that we have learned over the last so many years in this business is that you cannot overpay in your rental commitments. Otherwise, your economics will just get distorted. And having put in the Capex to grow that store, it's very difficult to actually come back to the profit margin. So my broader sense is that we will maintain pretty much the same ratio that we have today.
Right. Just one follow-up there. So if I've seen through some of your communications in the last 2-3 quarters, it was about 20 stores is what you were sort of guiding, and this sort of is now getting accelerated to about 35 stores. So any color in terms of what's driving the acceleration of store count here, addition?
So the 20-store guidance that was given for FY20 was keeping in mind extremely well that quarter 1 and quarter 2 will not see more stores. Because of the fact that the fundraise was complete. I also mentioned it just before this call, just before your question, that the timeline for pipeline to mature is slightly larger, right? And we knew that our pipeline in quarter 3 and quarter 4, as in the stores hitting the ground, and quarter 3, quarter 4 will be higher. And today we have built capability inside the system to open, anywhere between 3 to 5 outlets every month. We have that capability. If we find good sites, can we cross, more than 40 in the year? Yes, we can.
All right. Understood. And the second question that I have is on the delivery. Again, one of the metrics I want to understand is incrementally the stores that you're opening. What are the ADS levels for delivery that you are seeing in the newer stores? Are they sort of matching what you are seeing in the stores which were there for more than 1 year? Incrementally, are the newer stores also seeing traction on delivery? Is what I want to understand.
Yes, they are. Barring the fact that some of these stores which are new on the platform also take more time for discoverability. This is not a Barbeque Nation phenomenon. This is general industry phenomenon. So as and when more customers hit that store, it gets discovered more and more. So barring that, I think we are launching at a pretty decent ADS, and then the growth in the initial was also very good. So we have not noticed any special or any different dynamics of new store on delivery side.
All right, sir. Thank you so much for your answers.
Thank you, Rakesh. Thank you.
Thank you. The next question is from the line of Trilok from Diamond Asia. Please go ahead.
Yeah, hi. Good evening. I just wanted to, check on, again, going back to delivery questions, with a couple of participants already asking that. So, are we trying to, I'm sure you must have, thought about, sustaining the momentum. Is there meaningful innovation or, thought process going on how to build that business, going forward? Because that is A, obviously higher margin business, and B, obviously, gives you higher throughput, and extension can also be a medium-term opportunity. Could you just help us understand on that part, please?
So, yes, thought process, yes, no doubt about it. I'm not sure about higher margin business because the food costs, packaging costs, aggregate commission put together make it a slightly lower contribution margin business. And if you keep on adding more and more, distinct kitchens, you'll have other operating costs like rents and manpower operating costs, right? So beyond a particular ADS level, yes, it will do that. Since we do it, so for example, in our case, what we do from our own Barbeque setup are higher margins. what we do from extension kitchens, even at say the ADS level are lower margins, right? But having said that, and that's why we're very cautious about the extension kitchen. We track margin by unit by month, right? So that is there. But having said that, yes, new product innovations are being thought of. There are some in pipeline also. I need to talk about it right now. We don't know when this will hit the ground. But by and large, delivery is a focus area. Delivery is also a growing market. We want to capitalize on the kitchen infrastructure that we already built in this country and use that for delivery. So that's what I can say to Log.
Okay. And when you initially, commented about 7 crore restaurant business, that's excluding delivery, or is it including delivery?
No, that's including delivery.
Okay, understood. Thank you very much, and wish you good luck.
Thank you.
Thank you. We have the next question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Yeah. So how much is the contribution of the top 20 restaurants to our revenue? Is this for Barbeque Nation alone? And secondly, how are we leveraging the various social media platforms that are available to us as an advertising, and particularly, when most of our customers do come there for, birthdays and anniversaries?
Right. So contribution of top 20 restaurants, which is approximately 12% of our total restaurant network, would be anywhere between 18 to 20% of the entire revenue. So not that there is no concentrated towards top 20. In terms of social media, digital media, we have a very in-house strong marketing team. The gentleman who joined us almost 6 months back as Chief Marketing Officer. A lot of performance marketing initiatives been taken. We do some spend on digital media on Facebook and Instagram. We have a lot of blogger activities that keep happening on YouTube and Instagram. So the data that we get, our data collection of dine-in guests is approximately 98%, which means that we get 98% of customers' mobile number for the table, obviously, for the group. One of the numbers, we obviously call back them for feedbacks. We also, send them, and sometimes promotional, vouchers in case the repeat customers are not coming in. We also work with few of the external agencies to help us in these programs. So it's pretty, I would say, well-oiled department who've been doing it now for a few years.
So just like delivery came in as a huge revenue contributor to us, is there any thought process within the team to develop more such revenue contributors, some different formats or which could emerge as a big revenue contributors in the future?
So yes, Faisal, we can, right? So there's 2-3 points here. One is capability. It's there in the system. It's about bandwidth and focus, right? So over the last 2 years, we obviously had a tough period because of COVID. It's very erratic, right? And over the 2 years, what we have done is stabilize the dining business in a very, I would say, phenomenal manner. There is also a pretty much playbook for any subsequent waves that come in. We have built a very strong delivery business, which is approximately 20% of our 18-20% of our top line. We have stabilized our international business in a manner that today is one of the best margin business for us. 3 years back, you would remember that our international business was dragging, and today it's contributing very handsomely to our return on capital employed also. And Toscano, we acquired 2 years back. The journey with Toscano has been along with COVID. So the integration and the growth that could happen with Toscano has been slightly delayed, but that has also now integrated very well, right? So in terms of diversified revenue stream, the company has already created just before COVID versus now. We have got 4 revenue streams. One is core India Barbeque Nation. We have Barbeque International. We have delivery business, and we have Toscano business, right? I think all of these are in a very strong footing today. And this year, if it's a normalized year, I would see the benefit of 20% of the top line coming from these revenue streams. This year, if it's a normalized year, I would see the benefit of 20% of the top line coming from these revenue streams. of all of these. That's my expectation. Adding something more, would be in a very methodical and thoughtful manner. We're not in a hurry to do it, but if a good opportunity comes in, we also have both bandwidth and resources to take it.
How is our equity participation from Jubilant help us in terms of best practices exchange with them? That's one. And secondly, would it be a right statement to make if I say that we would definitely grow around 15% in same store as well as new store terms for the next 4 years?
So, Jubilant obviously is a great partner, one of the very well-run food services company, and there has been no operating level interferences or discussions between both the companies. But at a strategic level, we obviously talk and we sound them off, right? Apart from that, I think they are one of the great partners and lot to learn from them. In terms of your second question on 15% growth, we should do that. So if you look at our current base, we are at around 185 restaurants today, and we are expecting to add another 35 to 40 restaurants. So while the number is around 20% growth on the existing base, at least even though you assume 5 to 6 months of operation for the full month for all these stores, at least 10% should come from these, and another 5 to 7% should come from SSSG. The other impact that you'll see at least in FY23 is the impact of normalized months. So quarter one in this financial year and quarter four in this financial year were slightly impacted by COVID. As we move into normalized month, the net SSSG is obviously will be far higher. Right. So over a period of next 4 to 5 years, CAGRs of upwards of 15%, I think we should be able to do, right. And if we don't do that, I think we have not done a good job. I think the country provides that opportunity. There's no doubt about that.
Correct. And this would be mainly tier 2 towns, tier 3, or that is you're agnostic to that.
No. So it's not tier 2 town. It is also metro and tier 1 markets, right? So I think they're very underpenetrated in metro and tier 1. In Bombay itself, including the Greater Mumbai region, Thane region, all put together, we only have 18-20 outlets. I think the city has much more potential. Same goes for Delhi. Delhi also, NCR put together, we have around 23 outlets. Just for Delhi, without NCR, we only have, 11 odd outlets. Delhi itself has potential to take far higher than that. So the growth will be driven both by metro tier 1 and tier 2, tier 3.
Thanks a lot.
Thank you, Faisal.
Thank you. Due to time constraint, that was the last question. I now hand it over to the management for closing comments.
Thank you all. Thanks for joining to this call. We look forward to a good year in FY23 now, and hopefully we'll connect in the next quarter with further updates. Thank you.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.